right, a very warm welcome for those that are joining us in the tropics, and I guess a good afternoon for those of you that might be down in Australia and in a slightly cooler climate than I am at the moment. Very warm, 32 degrees in Singapore, and it feels a lot hotter. But plenty to get through today. Before we formally start, Joel will formally introduce us and what we're going to cover today, but just a little bit of housekeeping from my side. You'll notice we've got the poll running. So feel free to pop in some answers there. It just gives us a bit of context for what to spend a bit of time on today. Obviously, none of this is going to be shared or reported on. It is really just for our own reference and information. Any questions at all as we go through today, fire them through. We've got the chat box. We've got the Q&A panel running. So as you think of them, fire them through. If we get a chance throughout the webinar, we'll tackle them. If not, we will leave them to the end. And anything terribly complex, we can certainly take offline and have those conversations more formally one-on-one where it's needed, but fire through the curly questions. We love a challenge. So on that happy note, Joel, I'll throw over to you and you can formally kick things off today.
Thanks, Jarrad. Hello, all. It's so good to just reading through the list of the people joining. Obviously, there's some people there that I know. It's good. Thank you so much for tuning in. And for the people that I haven't met yet, well, there is time. There is time. So, like today, we're going to be covering through obviously lots of stuff. It's going to go through, what's in it for the Aussies and what's in it for the expats. So we'll start by adding my standard disclaimer in this. This is what I like to call the do not sue me slide. This just basically means that this is for your entertainment purposes only. And if you do need personal financial advice, please reach out. I will be very happy to give you that. So what we're going to cover today, so this is the what's in it for me. We're going to go through a bit of an introduction about who I am, who Jarrad is, who Bradley is. They obviously can talk to you about themselves. Then we're going to cover what's some changes, particularly for superannuation, both for our resident and expats. Any tax updates. So we've got obviously the stage 3 tax cuts happening in Australia. The insights regarding property and how obviously tax, largely around property tax residency, how are these proposed changes that has been tabled going to impact obviously our expat client base. And then obviously the Singapore rental market, which, for those living in Singapore, I'm sure you've already felt some bit of a sting regarding some rental increases. I know lots of my clients have complained about that already. For I suppose the last 12 months, Jarrad, I'm sure you're going to be able to run your own insights into that. And obviously just what we can plan for regarding tax mismanagement, what mistakes, and obviously investment planning and inflation proofing these sort of our sort of finances. Again, if you have any questions as we're going through, please feel free to pop it in the chat. We'll be happy to answer that as we go through. Or if you've got another topic that you just for some reason wish to talk about, if we have time, by all means, we'll touch on that and address it at the end. So who am I? My name is Joel Kerin. I'm a senior financial advisor here at Ally Wealth Management. That is a gorgeous photo of my office located in South Perth. Although it's very, very wet and gloomy in Perth today, very heavy rain. So it doesn't look like that beautiful afternoon, slightly animated or AI-focused interpretation of the building. Now, as a financial advisor for Aussies, I look after our Australian-based clients and our expat Australians based abroad. So this could cover all parts of advice from, tax planning, wealth management, investment, personal advice, superannuation, retirement planning, repatriation planning. Basically, the list goes on. I do happen to now have clients in, I think it's 33 different countries around the world. So I've spent many of my lovely evenings with a nighttime dual tax agreement. Not my most favorite thing to read, but it is all part of the job. Now, enough about me. I'll throw over to Brad from Murphy Tax. You look quite dashing there, Brad. in that photo.
Oh, thank you, Joel, for the kind words. Yeah, I mean, cold and sunny Melbourne. It got down to 2 degrees this morning, but yeah. But who are we? Who am I? We're a specialised Australian international tax and expat tax firm. We do accounting for expats and also tax advice. We're a team of lawyers and accountants, so we can really help with tax planning and structuring for Aussies around the globe as they leave Australia or return back to Australia. So yeah, it's great to be working with Joel and Jarrad today. There's a lot of interaction and linkage between the financial piece and the tax piece for expats, so they very much do go hand in hand. And yeah, it's great to have two experts on the webinar as well. But yeah, we're looking forward to the session.
And of course, the man that needs no introduction, Jarrad Brown.
Thank you so much, Joel. Very kind. We'll keep this brief. Yes, look, oddly enough, our firm here in Singapore, I am based permanently here in Singapore. I've been here 11 years now, and work very closely with Joel and our Australian expat clients all over the world. And oddly enough, our licensee here in Singapore, GFC, started in Sydney back in '97. And then found that the majority of our clients were abroad, largely in Asia. And what on earth were we doing sitting in a time zone that makes no sense? So hence here we are sitting in sunny Singapore. So enough about us. Let's get into the content and why everyone is joining us today. So tax tips, traps, and insights. Brad, this sounds like it's got your name all over it. We might start with you, I guess, with some of the key things the ATO is watching. What do Australian expats need to know? What do we need to be careful of?
Yeah, thanks, Jarrad. So I guess we'll focus on here just what we're seeing from the ATO and some common issues for our clients as it relates to Aussies moving to Singapore or coming back into Australia. I think the first point is really a focus on tax residency. We'll touch on the new rules in a second as they're being proposed, but there's just been an increased focus on data matching with the tax office in Australia through foreign income coming into Australia or immigration records now. So immigration are swapping records with the tax office now. So we're seeing a lot more activity from the ATO in terms of sending out questionnaires to clients just to prove they definitely have satisfied the non-resident criteria in Australia. So that's been one sort of focus area. We're seeing a lot more focus around trust minutes for those with family trust back in Australia, to make sure that if you do have a family trust back in Australia, that the distributions from those trusts are going to the correct beneficiaries and they're being documented before the end of the tax year. There's something we haven't really seen until the current year. So there's a lot more focus as the ATO have announced publicly around trusts and their reporting obligations. So watch that one. The other one is just to make sure that if you can get on a tax agent list before 31 October to get the extension to May next year. So for those that don't know, if you file with a tax agent, you get an extension to file your Australian return until May next year, whereas if you file yourself, the deadline's October 31st. So those with the tax debt, might want to think about making sure you file with a tax agent to get the extension to file your return and pay your debt to the ATO. If you are due a debt, if you're due a refund, then maybe think about getting that return done earlier. The other one too, another tip for those moving to Singapore, which is often overlooked, is this deemed disposal you can make when you cease residency of Australia. And that basically looks at, what shares and investments and assets do you own when you leave Australia? And the upside of paying this deemed disposal or exit charge, as we call it, is that once you pay that exit charge, any future gain on the investment or shares or crypto is not subject to Australian tax. So if you're leaving Australia, you've got a private business, you've got shares in ASX stocks or US stocks, just think about paying that exit tax if you can, because any future gain will be outside the Australian tax net going forward. So it can be advantageous to look at that.
Brilliant. Yeah, certainly a common one we find with a lot of our clients. And I think perhaps worth highlighting, Brad, and correct me if I'm wrong, for those Aussies that are already abroad and may not have heard of what a deemed disposal is, or maybe thinking, gee, did I miss something? Did I do it? Did I not? Perhaps not too late to review that final tax return when they left and look at whether they should adjust that or in fact sort of go back and do that deemed disposal if it makes sense.
Yeah, for sure, Jarrad. That's true. Because I guess for the context there, when you do leave Australia, you've got the option to pay this deemed disposal or defer it. So if you defer that deemed disposal, that means that the future sale of those assets are subject to Australian tax at that time with no discount capital gain. So the tax can be quite high if you hold Australian assets and leave Australia. You defer that charge and pay tax when you're in Singapore. So that's right, Jarrad. Certainly makes sense to go back and look at the date you left Australia, which is where it's looked at, is the actual date you leave Australia, not the tax year. So just have a think about doing that and going back and looking to either amend that return or think about what it would mean for your 24 return if you left during the current year. Yeah.
Brilliant.
Yeah.
All right, Joel, we might throw this one over to you. Finally, a little bit of good news as far as tax in Australia is concerned. Very rarely do those words form the same sentence.
Again, depending on what side of the political spectrum you sit on, will determine whether that's good news or not. But yeah, so obviously starting from the 1st of July 2024, and it's also really important to realise that we are anticipating another budget to come out before these, obviously the tax cut laws have passed. And what that would essentially mean is if that were to change in any way in the budget, possibly in the first quarter of next year, it would require an amendment to that law. So, but as it stands, as of now, obviously the stage 3 tax cuts are coming in. And what that essentially means is essentially a flat 30% tax in between quite a large scale of income up to about $200,000. So that's essentially enabling quite a hefty tax cut for even moderate to high income earners as well. So you can see here on that table what that difference would actually make to your taxable income for the financial year starting from the 1st of July 2024. If you're earning $40,000 a year, well, unfortunately for you, the difference is going to be nothing. But as we move up the scale there, to as high as $200,000 a year, that is about a $9,000 tax saving. So, and as part of these measures that were introduced by the federal government, this was obviously on the back of a, stimulating the economy kind of measure. But as well, I believe, as an Australian tax resident, we don't get the benefits of, these lovely, handsome Singapore tax rates. So, I very much welcome the stage 3 tax cuts from a pure capitalist perspective in me. But yeah, obviously, this is just going to be extra money flowing into the pocket starting from the 1st of July next year. And I suppose the real question will come down to where that money is actually going to flow through into in the economy. So I suppose time will tell, and we'll see probably in the probably December 2024, should that go through, where that money's actually flowed through to.
Excellent. I think anything that brings down the Australian tax certainly makes it a little more palatable for anyone thinking about repatriating. Certainly a far cry from the Singapore tax rates, but at the same time, probably a far cry from the cost of living in Singapore as well. So knocking out $9,000 on a $200,000 income, look, I think it's a step in the right direction, that's for sure.
Absolutely.
Definitely.
Brilliant. Look, let's have a bit of a look at structuring your investments. And really, we want to look at, I guess, 2 angles here. One is, what options do you have to consider as a Singapore tax resident, or potentially as a non-resident of Australia? And then I'll throw over to Brad to talk through some of the options around, or from an Australian-based perspective, that you can think about both as an expat and as an Australian resident, but also in thinking about your return to Australia as well. I think as Singapore residents, we sometimes get into almost this trap, or perhaps being too comfortable or too busy, where because there's no capital gains tax, there's no tax on dividends, we sort of think we'll worry about tax later. And often later comes around very quickly, and before we know it, we're on the plane to Australia and we've left these changes too late. So there are a few different options that you have to consider. And when we talk about structuring your investments, we're talking about how you own your shares, your exchange traded funds, your Vanguard investments. So not things like property, residential property, commercial property, but those mark-to-market assets, the non-taxable Australian property assets. So from a Singapore residency standpoint, we have a few different options. You could set those investments up inside an insurance bond, otherwise known as an investment bond or an insurance-linked policy. They go by a number of different names. In simple terms, it's a life insurance policy that owns those assets. And by separating that ownership, we can achieve some quite attractive tax benefits, providing they're structured in the right way and the rules are adhered to, that potentially mean we can continue to grow and accumulate wealth outside of the Australian tax framework, even once you're back in Australia. Now, there are contribution caps on that. A 10-year term needs to be met before withdrawals can be made, but an option to consider nonetheless. And an option that is gaining, I think, a lot of interest, given some of the superannuation changes in Australia, which Joel will touch on a little bit later. Now, we do also have foreign trusts or discretionary family trusts in Singapore. Don't really serve a great deal of benefit for people returning to Australia. So this would really be if you're looking at asset protection in Singapore. So not a great deal of tax advantage here in Singapore, other than I think a lot of people getting into the trap of just being excited by the fact that they can tell people they have a trust. They just don't really know why or what purpose it's serving. And we do have foreign superannuation in Singapore, which sort of forms a bit of a blend of a couple of these different options. It does get a bit more messy. It does require setup of an SMSF, separation of capital and growth, which Brad can touch on, but certainly a bit more complicated. The other option to highlight before I throw over to Brad and Joel, anything you have to add here, is just the individual or joint direct ownership. So thinking through things like shares or ETFs in your own name, company stock, RSUs, employee stock options, all of these investments that grow and accumulate in your own name. Obviously, while you're in Singapore and you're a Singapore tax resident, there is no capital gains tax or dividend tax to pay. And as Joel rightly pointed out, what a wonderful place to be. But we need to think beyond Singapore because the majority of us are not going to retire here. So we need to think about what that looks like going forward. So Brad, on that note, I'll throw over to you to talk through some of the other options that we have to think about.
Yeah, thanks, Jarrad. And fantastic points there, which I definitely agree with. I mean, and that's a good point you raised in terms of there's really not a need for any sort of foreign structure if you're looking to bring investments or assets back into the Australian system normally, because they do get rebased their market value when you come back to Australia. Any assets you hold in your personal name does get reset to capital gains fair market value when you come back to Australia. So that means you're only really paying Australian tax on any growth on those investments after you move back to Australia, at which point in time you can move those investments into an Australian trust if need be. And that's normally far more effective than trying to manage a foreign company or Singapore company or Singapore trust from Australia. That does get quite tricky and expensive to navigate. So normally it's far more beneficial to hold investments, shares, stocks, private investments in your personal name as you come back to Australia. Now, a couple of points. Obviously, an Australian family trust is a key tax planning vehicle that most Australian residents use to protect wealth for asset protection plus tax planning. A couple of points to be aware of: if you are looking to leave Australia with a family trust, it would need an Australian director to sit as director of the trust to keep it complying with ASIC laws. So just make sure if you've got a trust in place in Australia and you leave Australia, you've got a resident director that's an Australian tax resident on there. Same for an Australian company. You've got an Australian private company that also needs a resident director on there to keep it compliant. But really, having an Australian family trust is not always the best option if you're looking to move to a tax-friendly country like Singapore, because having that family trust while you're in Singapore effectively locks in any investments in that trust to Australian capital gains tax. So that's not normally the best option. A family trust can be quite beneficial for certain investments, Australian investment properties potentially, given you can look to stream income out from that trust, because non-residents do get hit pretty hard on Australian investment properties with foreign income taxes and land taxes and whatnot. But it's very much there's never a one-size-fits-all approach to these things. So certainly make sure you get personal advice The other one, just quickly, a self-managed super fund is normally an issue if you do have one and leave to become non-resident of Australia, in that it will be non-compliant if you're overseas on a permanent basis. So just make sure that if you do have a self-managed fund back in Australia, either you have a power of attorney in place over the fund if you want to keep it active and going. Otherwise, consider rolling that fund into a retail fund before you move and leave Australia, which Joel and Jarrad can no doubt also assist with as well. So I think the key message there would be never a one-size-fits-all approach. Be mindful of overseas structures coming back to Australia, and just make sure you manage your existing structures in Australia before you leave. Yeah.
Absolutely. And Joel, I know, well, both you and I are big fans of Australian super. We might leave the commentary and the strategies to the super section because there's probably quite a lot to cover there, and I think a very important one for expats. We do just have a very relevant question that we might just answer now that's come through. And Brad, I'll throw this one over to you if you like. It's nothing too curly. So the question is, if I bought an asset, so I bought a share for $1,000 whilst a non-resident, and it falls to 500, I go back to Australia while it's 500, and it goes back to $1,000. Do I pay tax on that capital gain of the 500?
Yeah, good question, Andrew. Yes, you would. So effectively, the capital gains cost basis would be the value, the $500. When you came back to Australia, you sell it for $1,000. The gain's going to be the $500 gain in that period. If that period is more than 12 months, you get a discount gain to reduce that gain by half. So effectively, the gain will be $250 if you hold that share for more than a year after you repatriate back to Australia. Yeah.
Brilliant. Hopefully that helps, Andrew. Probably not quite the answer you're looking for potentially, but the answer nonetheless. The joys of tax. Not a lot of grey. Now, the other little tax trap tip insight to be aware of is, sorry, just clearing that question there, is just this US estate tax exposure. And that is particularly relevant for those in Singapore who are receiving company stock usually, or who may be buying US domiciled ETFs or US domiciled shares. Now, domiciled largely means trading on the US stock exchange, so New York or the NASDAQ for most people, or a US domiciled managed fund or unit trust. So if you are working for, let's say, Amazon or Google or Apple, and you're receiving stock, this could be quite relevant for you. And how it works is, as a Singapore resident, you have this $60,000 threshold. So if you own more than $60,000 worth of US stock or ETFs or unit trusts, the portion above that of your estate, now that is estate with an E, is exposed to estate tax in the United States. So that's up to 40% of your estate is exposed should you pass away whilst a Singapore tax resident. Now, when you're back in Australia, that threshold changes. It is significantly higher, so it's usually not something that most people need to worry about, but whilst in Singapore, definitely one to give some thought to. How do we get rid of it? Well, really, you have three options. One, you can roll it into an insurance bond, which doesn't have that same threshold issue. Number two is you roll the dice and figure, well, I'll be gone, so my family can worry about that. A lot more common than you would perhaps imagine. Or option three is you sell down your US exposure and you look to get that exposure another way if you so desire. So for example, you might have a NASDAQ ETF that just gives you exposure to the 100 tech companies in the US listed on the US stock exchange. You might decide to sell that and instead buy the Australian listed version of the same thing. It removes that estate tax exposure, but effectively gives you an identical investment. So not one to be ignored, not one we enjoy assisting with and tidying up when these issues do become issues for the family, because obviously this can become quite problematic. Okay, now we do have a bit of an estate planning question. We might leave this one till a little bit later because we've got a few things to cover around the estate planning side. I'm just reading through, so speaking here. Yeah, we might tackle this one a little bit later if that's okay. just to make sure we get through everything. But noted that it's there. Adam, thanks for sending that through. Now, tax residency. Brad, look, I'll leave this one to you. Not that you're not probably sick of having this conversation. Gosh, it's been part of our updates and our webinars and seminars for so very long now. I almost don't remember a time without it. But naturally something I think on the minds of so many. There is an awful lot of noise, I think, in the media and being spread, particularly amongst Australian expats. I mean, gosh, we see some terrifying comments bordering on advice in Facebook groups. So I think it'd probably be good to perhaps give everyone a bit of peace of mind, where things are at, what's happening, what the ATO is thinking, and what this means, particularly for Australians in Singapore.
Yeah, thanks, Jarrad. I shouldn't complain. I guess it keeps me employed in a job, so it could be worse. But yeah, it certainly has got plenty of media attention, these new residency rules. Maybe we just start with the current state of play. So effectively, at the moment, as you can see on screen, there's really 4 residency tests in Australia to be concerned about. Often the key one for Aussies moving to Singapore is this domicile test, which says effectively, if you're an Australian citizen, you must establish a permanent place of abode in Singapore to be a non-resident. And that would normally entail at least a period of 2 years living in Singapore with a job in Singapore or a business in Singapore, or certainly long-term accommodation, lease or property in Singapore. And also at the same time, cutting your ties to Australia. So if you've got a property in Australia, make sure it's rented while you're away, limiting your time in Australia, and anything towards Australia must be on a sort of temporary basis to satisfy that domicile test. So I think that's a really key point for Aussies going to Singapore. A move of less than 2 years to Singapore would often mean you'd remain an Australian tax resident, and that's where the treaty with Singapore would come into play to say that you can be a dual tax resident of both Australia and Singapore, and in that case, there's certain, I guess, tests in that tiebreaker treaty to look at where you're resident under that treaty, which is normally where you maintain permanent accommodation would make you resident under the treaty. But the other point would be, obviously, if you spend more than 183 days in Australia in the income year, you're also tax resident of Australia under that test. But really the key one at the moment is this domicile test. And the ATO actually issued a very detailed and lengthy ruling a few months ago. They basically consolidated a whole bunch of recent case law that had came out. So that new ruling didn't really change a lot as to what was the historical position, but did put a bit more emphasis on it's actually harder and harder for Aussies to break residency of Australia. But that didn't really change a whole bunch from the existing rules. What this new rule that everyone is up in the air about and the media is giving it lots of attention is this proposed 45-day rule, which was actually announced in the budget back in 2021-22 by the previous government. And it did go quiet for a couple of years. A lot of people thought after this new ruling was announced that was the end of the 45-day rule, but it's come back to life and reared its ugly head again. Basically, the government has announced a new consultation into these rules to see if there's merit in them going ahead. So they're seeking feedback from the professional bodies on the rules. So basically what the rule was essentially, if you had Australian ties, basically if you're an Australian citizen or permanent resident with Australian property or employment or business, your days in Australia are limited to effectively 45 days a year, which did, cause a lot of uproar. So I think a few important points on that 45-day rule. One, it's not law yet. There are no laws have been released. We've seen no exposure draft or laws. Secondly, there is likely to be some tax treaty relief for tax treaty countries like Singapore. So, of course, we don't know that yet until the laws have come out. But there was some talk about having a carve out or exception if you're normally a tax treaty resident in Singapore, for example. So that's something else to bear in mind. And thirdly, the start date, I guess it could be as early as 1 July next year in theory. That does seem a little bullish, given it's not that far away now. But I think certainly watch this space. And the consultation period does close on September 22nd. So I think we'll hear a lot more later on this year about how those rules are going to come out.
Excellent. So
Yeah.
yes, watch this space, I guess.
Yeah.
Yeah, potentially one of the biggest changes that expats have arguably seen in our lifetime, and potentially quite impactful for those not paying attention. So certainly, yeah, watch this space and seek proper advice. Please do not rely on the nonsense on Facebook. It is quite terrifying.
Yes,
But
certainly
yes.
agree with that. Yeah, for sure.
Watch this space. Now, Brad, look, I might throw this one over to you again, just looking at the sort of tax side and I guess sort of the commencing residency piece for those who are looking at moving back to Australia, and some of the things they need to think about around, okay, when does tax residency start? What do I need to think about my offshore assets? I know you've touched on a bit of this already, but yeah, I guess just anything else that expats need to be mindful of.
Yeah, sure, Jarrad. So yeah, as we spoke about before, tax residency, normally you'll be resident on the date when you actually do arrive back in Australia, not for the full year. So just be mindful of that. The period of the income year before you return to Australia would be a non-resident period. So you'll be a part-year resident in the year you return from the date you do come back on a permanent basis. Just be mindful of obviously triggering a residency too early if that's not the intention. And the context being there, if you come back to Australia, or the family comes back to Australia, say before you, and you've got property in Australia, and the other spouse and kids are in the property, that can definitely be a trigger for residency in Australia. So something to be mindful of. The upshot of your assets when you come back to Australia is that they do get rebased to market value for capital gains purposes. And that's obviously good news. And you can think about perhaps moving that share portfolio or investments into an Australian trust at that time with normally no tax. As Jarrad and Joel mentioned too, on the life insurance bonds, they can also be effective when you do come back to Australia. As Jarrad was mentioning, you do have that period of 10 years when you can liquidate that bond, normally with no Australian tax on that liquidation. Something to bear in mind. Because it can be quite hard to keep foreign structures outside of the Australian tax net. So, Singapore companies, Singapore trusts, for example, it's quite a common question we get. Can we maintain our Singapore company and sort of live back in Australia and manage the investments and keep the income and gains outside the Australian tax net? It's normally quite difficult unless you're willing to give away the shareholding and control of those vehicles. Given Australia's got these two laws called the Central Management and Control Rules and the CFC rules, and those effectively say that if you manage a foreign company from Australia, it will be taxed as an Australian company. So just one to watch out for. Not saying it can't be done; it certainly can be, but just needs some good advice and planning. As Jarrad mentioned too, on the Singapore CPF, if you do want to keep that and return to Australia with it, Australia would tax the growth component of that Singapore fund. So the contributions that have been made by you and your employer are not taxable, with just the growth element as ordinary income. So depending on your personal circumstances, there could be some merit to cashing it out before you do come back to Australia. But yeah, definitely get advice on that. And I think the big one we see that's often overlooked with expats leaving Singapore is it's twofold, and Jarrad and Joel will probably jump in here. There is a taxing point if you have employee share options or shares when you leave Singapore. And I might let one of those guys elaborate more on that. But just be aware too that any vesting or exercise of options that happens from Australia is actually a taxing point in Australia as ordinary income on the market value of those employment shares or options. And even though they may have been granted in Singapore and basically in respect of almost entire Singapore employment days, Australia would still tax it if a vest or exercise happens while you're in Australia. So watch out for that too.
Excellent. Yeah, certainly one to be very mindful of with this deemed exercise rule, or as it's informally known, Singapore's exit tax. So any unvested shares, restricted or your RSUs, employee stock options, everything that's unvested that you're retaining or receiving the benefit of is basically all taxed as if it vests. So when you are planning for your exit and your final tax bill, do not ignore that one, because you cannot get rid of it. You really cannot get around it. It's not something we can make disappear by restructuring, particularly given that a lot of it is restricted stock or restricted options that are unvested. So just be very mindful of that one. Start planning early. Start speaking with your HR, and seek advice, obviously from qualified accountants and qualified financial planners, to make sure that those tax bills are not catching you by surprise. And to Brad's point, to make sure that nothing is vesting or exercising or hitting your Aussie bank account or even your Singapore bank account once you're back in Australia that doesn't need to be, because that could also be another nasty little surprise for you when you land back in Oz. Now, before we move on, we do have quite a pertinent question, and Joel, I'll throw this one over to you. Seems quite relevant given the section we are heading into. And that is around government super funds or Commonwealth super funds. So if a non-resident, if an Aussie expat has a government super fund, would you recommend rolling into a non-government super fund?
So there's sort of a couple of parts to this question. So there's sort of three kinds of main, or actually no, four main government superannuation funds. So it really depends on what what fund you're actually a member of. So you've got obviously the CSC, or the Commonwealth Superannuation Corp. They issue basically four sort of really key superannuation products. There's PSS, being the public superannuation system, the Commonwealth superannuation system, military super, and PSAP or PSSAP. So depending on which one you're a plan of, now where we were talking about the tax residency of, if you're a tax resident of Australia, where you might fail this test if you're a member of a contributing super plan. What we're sort of referring to is the Commonwealth superannuation plan itself. So if, for example, you're employed by the Australian government, let's just say you're working for the Department of Foreign Affairs, right? And in your role, you're posted to another country, whether that be Singapore, anywhere around the world, it's very likely that you will fail that test. So you will be treated as a tax resident of Australia, because you're being positioned in more or less a more diplomatic way outside of Australia. It's also really important to realise that if you travel overseas with your spouse or children, it's also that they, in that professional capacity, whilst a contributing member to either PSS, CSS, or military super, that you will remain a tax resident. The only one that's not counted in that is PSSAP, which is the accumulation plan. The accumulation plan basically is a government-supported superannuation, which sort of anyone can be a member of, or they have at least at some point worked in the Australian public service.
Brilliant.
So I hope that
and Joel, sorry.
I just saw the second part of his question come through. So if you have your question pertain to Q Super or Queensland Government Super, no, it's irrelevant.
Excellent. So yes, any other I guess super funds other than those Commonwealth super funds that Joel mentioned, seek advice. Yes, super, even though you may not be contributing as an expat, is certainly a very important vehicle that we want to make sure is working for us. Now, on that happy note and very topical issue, superannuation for expats. So Joel, perhaps I guess you can just give us a brief sort of synopsis, snapshot, some of the recent changes, particularly what expats, I guess, need to be mindful and aware of when it comes to some of these recent updates.
Now, I think I'll start to by prefacing this largely in that, even if you are an expat, if you plan on retiring in Australia, it could be, quite silly for you to forget about superannuation, because superannuation by far is a very lucrative retirement vehicle. And essentially, in full retirement stage, you get essentially tax-free income and tax-free dividends. I'll touch on that as we go on in a couple of the slides. But a couple of the changes that have happened, just recently, which I'll go through now. The half minimum pension drawdown ceased. So what happened back in 2020, when basically the world shut down because of COVID, basically the stock market also crapped itself, and we all had to sit at home and basically twiddle our thumbs for a period of time. The Australian government announced basically an extension to say that of your minimum pension drawdown. So if you have an account-based pension now, you have a minimum drawdown per year. Basically, that was halved. That ended in June 2023. So from this financial year going forward, if you have an SMSF, you also might need to update what you're drawing out of your SMSF, or most retail or industry super funds will automatically recalculate your minimum pension drawdown and adjust that if you haven't drawn down your minimum. But SMSFs, again, really important to have a look at, what the balance that you had inside pension, making sure that you're meeting that minimum drawdown. The SG contribution rate increase, so that increased as of 1st of July this year, so that's gone up to 11% from the 10.5%. So where that could, if you're making any sort of salary sacrifice contributions in Australia, just make sure that you're not going to go over your your concessional contribution cap, which I'll touch on again later. The downsizer contribution age, so that was previously age 60, that has been reduced to age 55. This is more or less in a response to the housing crisis and all of the older generation of Australians holding on to very large real estate in Australia. So again, downsizing contributions are available. They're $300,000 per person. And they are exempt from all other superannuation caps. So it could be a really good stepping stone to get potentially $600,000 into the superannuation environment, where, as we said, in retirement phase, that's completely tax exempt. In addition to that, the transfer balance cap was increased to $1.9 million. That is a maximum amount that you can have inside superannuation in an account-based pension phase. There is also a concessional contribution carry forward that was brought in by the Malcolm Turnbull government back in 2017, which basically allows you to use 5 years of unused concessional contributions, providing you've got a super balance less than $500,000 in one go to claim a tax deduction. That can be very helpful, for example, if you have perhaps a CGT event. You could potentially look to move a bulk amount of money inside superannuation to limit the impact of that CGT event. So if back to, I suppose, my earlier point on salary sacrifice, this is quite a very lucrative retirement saving strategy for most Australians. We do have, again, much higher tax rates here. So anywhere where we can save a bit on tax is always going to be a welcome. And again, trying to put money into the superannuation environment where the maximum tax bracket or the maximum tax rate there is 15% becomes quite attractive. So you can see there that if you are working and you're earning, say, a gross salary of $100,000, your SG contributions on that $100,000 would be $11,000, so or 11% of your income. If you added an additional $10,000 in salary sacrifice contributions, yes, you would pay an additional contribution tax because contributions into superannuation are taxed at 15%. But however, you can see there down the bottom there, the net income is not making $10,000 worth of difference. So you can see here there's about a $6,550 net difference between that net income for a $10,000 essential additional contribution going inside super. So again, it's always worthwhile to, I see sort of two ends of the spectrum, particularly in financial advice, and that is, right, do we wait until we get older and try and funnel and dump a great deal of money inside superannuation in one go, or do we take the long burn approach? Either is going to work. But I suppose it depends on what sort of capital, but you do have contribution caps that do cap out in with those larger end contributions. So with superannuation for our expat clients, we've got essentially think of superannuation largely as a tax structure. It is not try and get around the idea that, you know, I'm with this one super fund, so they treat it differently. Superannuation largely is a tax structure. And sort of the things that we can't control, I put there on the left, that's sort of the contribution limits. That's controlled by the government about how much we can put in there. We've got the concessional contribution cap, which currently sits at $27,500. And again, you've got your carry forward concessionals available for that. So in addition to that, you've got your non-concessional contributions. They sit at $110,000 a year. And you also have the ability to do what's called a bring forward rule. So that is so you could essentially bring 3 years of any non-concessional contributions in one go. So you could essentially have, if you sort of do your timing nicely, obviously we've just gone past end of financial year, but I know for a client of mine, I had them do a $110,000 contribution on the 28th of June. And then on the 2nd of July, they did 330. So it essentially allowed $440,000 to enter the superannuation environment for the purpose of deriving a tax-free retirement income. The sort of things that we can control inside superannuation, again, are the investments. So if you've just sort of as a member of a fund, that could be a retail or industry super fund, you've made no selection per se, you might just be in their default My Super or balanced option, as they may call it. It's really important to note that there's no standardization of that investment profile of what is a balanced fund, what is a a My Super product. So each fund is going to be quite vastly different between what they call a balanced fund. So if I take, for example, if you're, say, for example, a member of Host Plus, right? Host Plus have a balanced fund which has about a 90-10 split, so a 90% growth, 10% defensive exposure of their asset allocation, whereas Australian Super sits at about a 74, 26 sort of 24 exposure. So it just, again, there's no standardization. There is a different element of risk that will be taken on between each fund. So just obviously have a look, make sure that what you're actually invested in is going to derive or fit within your obviously ideal investment profile there. The benefit of, again, withdrawals that happen when you are retiring, you've obviously got an accumulation account and a pension account. Pension accounts are where the value of superannuation sits. Again, there's no tax on earnings or gains. There's no tax on the income that's paid to you. And also you have the ability to revert your pensions to perhaps even your spouse. So you can see the difference there. I've put a bit of a tax calculation. If you had an investment property worth 1.9 million versus 1.9 million in super, the rent payable being the exact same, you would pay a little bit of tax. So again, not saying that investment property is bad, but it's just obviously to consider what that allocation looks like largely.
Brilliant. Now, a very timely question, and Joel, I'll throw this one over to you. Thank you, Andrew. Gosh, almost feels like we planted this one. It's an excellent question. I think one that a lot of Aussie expats should be very aware of. And it's quite simply, can I utilise, say, for example, one of or multiple of the previous 5 years worth of unused concessional contributions and save this year for future years? So under that carry forward provision, could I use, say, for example, the last 3 and not use this one, or potentially even the last one just yet, because I want to use that one in future?
Of course. So how it essentially works is, if you exceed your cap for this financial year, so let's just say the 2023-24 financial year, what the ATO will look back on is go back 5 years and say, right, where was the next available cap that we could use? So you can use, obviously, if you would always exceed your cap in 2023-24, but then it would roll back to up to 5 years ago to start using that cap. Now, if you go forward for next financial year, let's say 24-25, and you use your cap there, it will then look back to up to 5 years ago of any unused cap. Now, you've got to keep in mind that any year that you've exceeded your cap, you're not going to have any cap available. So it really depends on what and the timing of these contributions when they come in.
Yeah, I think too, just
Excellent.
on that, just where we see that 5-year catch up really quite advantageous would be, as the guys touched on, like if you're coming from Singapore to Australia and you haven't utilized that 5-year concessional cap, you can put in, 27,000 times, 5 essentially, give or take a few dollars, into your Aussie super, right, which would reduce your employment income, taxable income. So it's often overlooked and really quite advantageous for returning expats because that can reduce your employment income taxes in Australia. Secondly, if you've sold a property in Australia, you can also apply this same concept to reduce the tax on Australian capital gains tax from Australian property as well by utilising pre-tax concessional contributions to offset the capital gains on Australian property CGT. So yeah, really quite an important rule, that one.
Absolutely.
Yeah.
Just responding to Andrew's question there. No, yeah, it's so the question is, so this year first, then last year, then the year before, rather than no. So it goes this year first, 5 years. And so it always looks up to the maximum of 5 years retrospectively back.
Perfect. So just be mindful and don't let them expire if you want to use them, because they will drop off every 5 years, well, every year. 5 years ago, of course. And I guess just one other question while we've got it there. Contributing to an Aussie super fund from Singapore, will these contributions be taxed? And Joel, probably a good one to answer with this here, given we have it as well, just to talk us through the different contributions.
Yeah, Mary, thanks for your question. So will they be taxed? It largely depends on what kind of contribution that it is that you're making. Now, if, for example, I'll use this example that we've got here where we've got taxable Australian property. If you're adding a contribution to superannuation for the purpose of claiming a tax deduction, so in this example, let's just say we've got rental income or positive net rental income in Australia of $27,500, right? As a non-resident of Australia, you would pay non-resident tax, which sits at 32.5% from the first dollar. So you would get a tax bill from the ATO of $8,937. If you add a contribution of $27,500 and claim a tax deduction, that essentially wipes out the need for that ATO assessment to come from them as a non-resident tax. But what happens is that kind of contribution, a concessional contribution, when it enters a superannuation environment, a contribution tax of 15% is applied. So you can see that whilst you do pay, in this example, $4,125 in contribution tax, you do get essentially a tax arbitrage event there of 17.5%, because that tax is at least is much less than the 32.5%. Now, if you're just adding contributions for the purpose of building up your superannuation fund in anticipation for retirement, then, and if it's being added as a non-concessional contribution, then that contribution itself is not taxed. But it's also important to realise that whilst you remain in accumulation phase, any dividends, distributions, capital gains, any earnings that happen within the fund, they are taxed at 15%.
Brilliant. Hopefully that clarifies that one for you, Mary, but thank you very much for the question. So moving right along, the carry forward, Joel, I think we've probably covered this one well and truly for everyone. Certainly want to be very mindful of And I guess the last critical point for everyone to be aware of is this $3 million cap. What on earth is this? What was the Australian government thinking? What does it mean?
So basically, the Australian government has come out with it was probably within the last 6 months that they ideally want to cap the concessional tax rate on earnings inside superannuation at below $3 million. Because the reason they've sort of introduced this is because there's a couple of super funds that have, millions and millions, probably even some of them are even up in excess of $50 million inside superannuation. And what the government is saying is that really for the purpose of deriving retirement income? You having $50 million inside superannuation, are you really trying to derive a retirement income from that? Now, obviously, that's open to interpretation. Some people may have very expensive tastes. And, in that case, maybe they do. But I'm not here to cast judgment. But they're basically saying that if you have funds in excess of $3 million, then the earnings on that would attract an additional 15% tax. So upwards of 30% tax on superannuation earnings. The downside of this is they didn't include in that sort of advice or discussion paper or law was that it would be indexed. So it basically is saying, right, you can't have more than $3 million in super starting today. Well, it's not law yet, so it's really important to note that, but they hadn't indexed it, and I'm sure there's going to be a little bit more working paper to come out around this. But let's just say, for example, what is the real value of $3 million if you're 25 years old today? Well, that's essentially at 4% inflation, that's equivalent to the equivalent value of only having 624,000 in super now. Now, that is well shy of the current pension caps, sitting at $1.9 million today. So again, I think largely there would likely be more discussion paper to come around about this. I'm not going to say it's right or wrong legislation, but I feel like every government likes to leave their little stamp on superannuation. And as a financial advisor, it sort of keeps me in a job that I need to reread the laws and rules around superannuation every 5 minutes. But we'll wait and see what eventually happens with this.
Excellent. I do feel like we've all got a bit of a nasty lesson in the time value of money and inflation over the last 12 months. But hey, if that's what it takes for everyone's financial literacy to take a step forward, then so be it. Let's hope there's some silver lining from all of this. Now, moving right along, I am very mindful of time. So I'm just going to highlight some of the critical areas for people to be mindful of when it comes to property and tax planning. So we are specifically referring to Australian property and particularly looking at the sale of property and what that looks like as a non-resident and I guess some of the sort of key financing strategies. So Brad, I'll throw it to yourself if you like, just to talk us through some of the high level information around selling your own home, what the main residence exemption looks like for expats versus an investment property.
Yeah, thanks, Jarrad. Yeah, I think it's probably the biggest issue we see would be Australians that move overseas, become non-residents and look to sell their family home back in Australia. So effectively, to get the main residence exemption now on your Australian home, you must be Australian tax resident when you sell that property. So really, really important that you plan on not selling your family home while you're overseas, because it would attract full CGT when you sell that property. So certainly plan on selling your family home either before you leave Australia or once you return to Australia as a tax resident. You don't actually have to reside back in that same home to get the exemption, but you must be an Australian tax resident when you sell that property, which is super important. And that rule did change back in 2019, 2020, and did catch a lot of expats off guard, especially during COVID. But a couple of points there, like you can manage it to retain the full exemption. Effectively, you can rent out your Australian home for a period of 6 years while you're overseas and still retain the full exemption for that whole 6-year period. So you could, leave Australia, live in Singapore for up to 6 years, come back to Australia and sell the property from back in Australia, and you get the full exemption still under that 6-year rental rule. So that's one to certainly bear in mind. Would really strongly recommend getting advice around that, because it can be complex, and it's quite important to get the timing right around that as well. There's also a 12.5% withholding tax that applies if you don't have a clearance certificate from the ATO when you sell your Australian property. So be mindful of that. The other one would be investment properties in Australia. Certainly expats do get hit pretty hard with taxes from a capital gains and income tax perspective. First one would be that Australian residents get a full 50% discount when they sell an Australian investment property, but non-residents don't get that discount capital gain. So if you've acquired an investment property and you've been non-resident for the whole period, you won't get that discount. So when you sell the property, the tax could be up to 40 to 45% on sale. And that's why it's important to think about how to hold that property. Does it make sense to have it in a trust, for example, where you can distribute income to Australian resident beneficiaries, or have the shareholding split between Australian resident owners and non-resident owners? So the tax can be split between the Aussie resident versus the non-resident. And obviously the property is going to be negatively geared. That's a plan to negative gear an investment property, which, given the way interest rates are going at the moment and land taxes in most states, a lot of properties are definitely making losses at the moment. I mean, from a tax point of view, that's quite good news, because you can carry forward those losses indefinitely to offset other income. And you normally want to have a negative geared property in a higher income earning spouse's name to offset their higher income. In contrast, if there's no debt on the property, so it's positively geared, think about having it into a lower income spouse's name, so they pay lower taxes on the income and gains. But yeah, just again, never a one size fits all approach to property in Australia. But some of the key points would be those, I think. Yeah.
Brilliant. Thank you very much, Brad. I think, certainly gives people a lot to think about. Property, I mean, I think for most expats, but especially Aussie expats, is a very attractive asset class. Obviously, the power of leverage with no margin calls does remain quite attractive. But yeah, leaving those tax considerations or thoughts around the tax consequences until retirement is not a lot of fun when you're weighing up whether you want to pay $1 million in tax or $500,000 in tax. It all gets pretty ugly. So certainly give that a bit of thought prior to taking the plunge. Now, I am mindful we are just over the 1 hour time frame, so we might wrap it up there. Anyone else with any questions, do feel free to fire them through. Adam, I'm mindful we haven't touched on your question around the estate planning. If you're happy to, we'll take that one offline, because I think it's going to be a little more complex than a brief answer on a webinar would really add value to you.
Yeah, Adam, I'm happy to answer that one offline. I've got a US partner that can help as well. Yep. Excellent.
So in good hands there, Adam. But a huge thank you to everyone who's joined us today. Huge thank you to both Joel and Brad. Excellent content. Hopefully everyone's gotten a lot of value out of that today. Obviously, personal finance and tax go hand in hand, and one definitely shouldn't be looked at without the other. So thank you very much for joining us. We will be popping a recording up on the social channels, so check it out. It will all be there. Fire through any questions that you have that we haven't tackled today, and have a great afternoon and enjoy the rest of your week.